So we are 9. Okay, so well, let's start this session. So good afternoon for the ones that are in Europe. Good morning for the ones that are in North America. And so it's a pleasure to welcome you to this session of the International Association of Energy Economists. And in fact, it's the first time that it's being online. So it's kind of also a first that on what you are doing. So I'm Maxime Schenckery. I'm currently director of the Energy and Energy Economics and Management Center in the IFP School. IFP School is an engineering school based in Paris, where we've got also kind of 4 master in energy economics, as well as a PhD program. And it's really, for me, a pleasure to share this session. This session, I'm sure it will be a very nice session because we've got very nice speaker that will talk about the oil industry, and it will be kind of applied research, applied economics about the oil industry on how, in fact, to find new ways to create value in the oil industry. Each of the speakers will speak during 20 minutes with its presentation. So you can share your slide directly, and that way also have the pace that you would like for the presentation. After that, there will be 10 minutes question. We'll start with Mrs. Noha Razek from Regina University. So Noha, please, the floor is yours now.
Thank you, Maxime. Can everyone see my slides before I start? Just double checking.
Yes, perfectly. Thank you.
Okay. I just want to close this window so I can see my slides. Okay, so it's a great pleasure to be talking about our paper entitled OPEC plus reasonable oil price level notion and the external break-even in Saudi Arabia, Russia, and Canada, accounting for economic cycles and pipeline politics. We started that paper in 2019, and it was around then when we submitted it to the conference. But since then, there have been a lot of developments. So this paper has been developed a bit further, and accordingly, we actually changed the title to the oil price threshold effect on external balances in Saudi Arabia, Russia, and Canada, accounting for geopolitics and environmental sustainability. It's co-authored by myself, assistant professor at the University of Regina, Professor Emilson Silva at the University of Alberta, and Associate Professor Nyakundi Michieka at the University of California in Bakersfield. As you can see, the paper deals with 3 countries. So there is a lot of details and effort put into the paper. So during that presentation, I'll try to give an overview. But I welcome all comments and questions so I can develop the paper further and even build on it for future research. So the outline for my talk is as follows. I'll talk about the objective, the background, and the importance of the topic. And then I'll talk about the literature review and the contribution to existing research. From there, I'll give an overview about the model, methodology, main findings, and then I'll conclude. So for the background, we know that the declaration of cooperation between OPEC and other non-OPEC members took place in 2016, and this has led to OPEC+. The impact of OPEC+ started to be more sensed in 2018, and this is when I started working on that paper. So from the website of OPEC, the objective of OPEC is to seek a sustainable, stable oil market and establish a reasonable oil price that benefits all industry stakeholders and the global economy. So the question that intrigued me actually is what is a reasonable oil price? So when OPEC decides to meet and cut or increase oil production to influence oil prices, what exactly is the price in mind? So this is what we try to answer in this paper. What is a reasonable oil price? And basically, an oil price that is reasonable for OPEC plus, is it reasonable for non-OPEC plus members, particularly high-cost oil producers? And within OPEC plus, an oil price that is reasonable for Saudi Arabia, is it reasonable for Russia as well? And given the developments that happened, particularly last year, the 2020 oil supply and COVID-19 induced demand shocks, that resulted in an acceleration of energy transition. Would that reasonable oil price differ if we account for environmental sustainability? So basically, the objective of this paper is to assess the oil price threshold effect on the current account for the countries of interest to determine the oil price needed to attain external break-even. And by external break-even, I'm actually looking at what is the oil price needed for the countries of interest to be able to finance their international financial obligations to the rest of the world. The importance of the topic, to know that actually we need to answer a few questions. So first of all, why study the oil price threshold effect? Basically, that would enable us to gauge the outcome of the Saudi-Russian-led negotiations, the OPEC plus negotiations. This is particularly important because whenever OPEC plus meetings are approaching, or there's a likely announcement, or there is an OPEC plus announcement regarding change in oil production, we find that the global economy, international financial markets, they all respond to these announcements, even though oil production has not actually changed. So through our regression analysis, we are able to quantitatively gauge the direction of OPEC plus negotiations that are led by Saudi Arabia and Russia. And we do that by identifying the price level that is reasonable for their oil sectors and their economies. Why examine Saudi Arabia, Russia, and Canada? So basically, the largest producers in terms of oil production are Saudi Arabia, Russia, and the US, followed by Canada. We're interested in OPEC plus negotiations and the outcome of this OPEC plus, what is a reasonable oil price for them. And OPEC plus meetings are particularly led by Saudi Arabia and Russia. So if we're gonna look at OPEC plus, we need to study Saudi Arabia and Russia. Canada, on the other hand, is an interesting case because it has close ties with the US. It's a more diversified oil exporting economy than Russia and Saudi. It's not an OPEC plus member, and it has higher cost of production and more constrained takeaway capacity. And if we're gonna focus on oil producing provinces in Canada, so Alberta is particularly heavily dependent on oil, and hence faces the same economic issues as Saudi and Russia. So that's why we study those three countries. Why look at external break-even? Basically, when oil prices drop, the attention is directed to what is a reasonable oil price for a project to make profit, or for the government to balance its budget. But when oil prices drop, oil exporters' external balances, and including the current account, deteriorate. For a country with limited export diversification and a prominent oil sector, the current account and the oil balances are closely tied, creating a systemic relationship between the current account and oil prices. If oil exporters are able to manage their foreign assets, that might enable them to increase the resilience of their economies to oil price shocks. So this is why it is important to look at the impact of oil prices on the external balances. Why not just look at the impact of oil prices on the fiscal balance? Basically, the relationship between the fiscal balance and external balances is neither one-to-one nor entirely independent. They won't be perfect substitutes unless the oil sector is fully owned and operated by the government. If that is the case, then if we examine the impact of oil prices on both the fiscal balance and external balance, it's more of a robustness check. But if it's not the case, then we should not just examine the impact of oil prices on the fiscal balance. We need to also look at the impact of oil prices on the external balances. When we looked at the literature review to try to find answers for our question and see how we can build on existing literature, we found that there's very limited research on the impact of oil prices on oil exporters' current account. And we could identify two sets of literature. One set applies empirical analysis, particularly panel data analysis, and the other set does not apply any modeling technique. I don't want to spend too much time on the literature review, so I'll just give you an overview here. An example from the first set is the second group that applies panel data analysis for a group of countries, including Saudi and Russia. They look at the impact of financial development, fiscal policy, demographics, and nonlinearity when examining the impact of oil prices on the current account. But when they provide the results, they do not provide it for, they only provide it for the entire sample without providing specifics about Saudi and Russia. And they do not examine Canada. Another example is the second paragraph on that slide here. I apologize, I cannot pronounce the name, so I'll refer to it as G and others in 2017. They examine the impact of oil prices on the Canadian current account. They account for the importance of financial development, the management of foreign exchange reserves, and the tendency to spend oil revenues and imports. But again, they focus on Canada. They do not examine Saudi or Russia. Killian and others in 2019 studied the impact of disentangled oil price shocks on different external balances for OPEC and Canada, but they do not study Russia. Using the Killian index, they are able to capture the business cycle. Only Killian and others accounted for economic cycles. Neither Killian and others in 2009 nor G and others in 2017 accounted for the impact of the fiscal policy. None of the papers in this set of literature accounted for the impact of geopolitics or sustainability. We have the second set of literature, Setzer and Frank in 2017 is a particularly important paper, but they do not apply modeling. They only use a simple formula to reach what they refer to as an external break-even. They study Saudi and Russia, but not Canada. With Kleinberg and others in 2018, they provide a comprehensive analysis of oil price break-even for tight oil project. They touch on fiscal break-even, but they do not examine external balances. Again, none of the papers in this set apply statistical modeling, and none of them study the impact of sustainability and nonlinearity. We, on the other hand, our contribution is that unlike Setzer and Frank, who employ a simple formula, we actually build an economic model to conduct an empirical analysis to estimate the threshold oil price levels and identify the high and low oil price regimes and the effect of the determinants across those regimes. We built on G and others in 2017. Similar to them, we account for the foreign exchange reserves, the propensity to spend oil revenues on imports and exchange rate. But in addition, we also account for fiscal policy, pipeline politics, sustainability, and nonlinearity. For nonlinearity, we use threshold regression analysis. We do not apply panel data analysis. We apply time series analysis so we can perform detailed case studies of Saudi, Russia, and Canada. Regarding the model, when we conduct our empirical analysis, we do not build a one-size-fits-all model for the three countries because each country has its economic characteristics, and accordingly, the variables, the characteristics and the features of the variables and the relationship between them would differ. But from our theoretical background, we can provide this generic equation that kind of dictated what variables we will use in our empirical model. So basically, we have the current account to GDP as a function of the budget balance to GDP, the Brent oil price, the oil price differential to capture oil price, to capture pipeline politics and geopolitics, the real effective exchange rate, the propensity to spend oil revenues on imports, and the foreign exchange reserves. For our empirical model, we, as I mentioned, apply threshold regression. I won't get into the technicalities here, but just to give an overview, an illustration about the theoretical model, the empirical methodology we use. Basically, this YT would be our dependent variable, which would be the current account to GDP or any external measure. We also include in the explanatory variable the lagged value of the dependent variable. This omega would be our threshold variable, which is the oil price, and the theta is the estimated threshold value. So the first regime, which would be the first equation, is the subset of observations when oil prices are below that threshold value. And the second regime would be the subset of observations when the oil price is above this threshold value. Following Stigler in 2012, we include the threshold variable, which is oil prices, as an explanatory variable as well. So that would be referred to as an open loop threshold autoregressive system. I will skip this one. For robustness, we use different combinations of variables. We check different threshold regression models before we decided on the open loop autoregressive system. We applied weak and strong exogeneity tests. We applied Wald tests to ensure that we have reached the appropriate number of regimes and the model is not too restrictive. All models in the model pass all diagnostic tests. In place of the oil price differential, which we use as a measure of geopolitics and pipeline politics, we use the capacity utilization of the oil and gas sector in Canada, the refinery margin in Russia, and the military expenditure to GDP for Saudi. To account for sustainability, we replaced the budget balance to GDP variable by an adjusted net national saving to gross national income variable that is calculated and provided by the World Bank, and it's adjusted by accounting for expenditure on education, as well as energy, mineral, and forest depletion, emissions, and carbon dioxide damages. So the main findings is that the external break-even is approximately 57 to 58 US dollar per barrel for Russia, 61 to 65 for Saudi, 74 to 76 for Canada. That means that if oil prices are in that range or below that range, that compromises these countries' abilities to finance their international financial obligations to the rest of the world. When accounting for sustainability, we find that those threshold values increased to 67 US dollar per barrel for Russia, 72 for Saudi, and 85 for Canada. These results are actually consistent with previous estimates by the IMF for Saudi, as well as by Setzer and Frank in 2017 for Saudi. For Russia, it's also consistent with estimates by Setzer and Frank in 2017 and reports by Eris in 2018. In terms of geopolitics, we find that it has detrimental effects on Saudi Arabia under all oil price regimes. Russia, on the other hand, has managed to weather the effect of Western sanctions. So it has been investing in strategic sectors beyond the oil and gas sector, has been implementing import substitution policy, and motivating investment in local R&D, has been diversifying its export markets, customer base, and sources of investment in infrastructure and upstream projects away from the West. Those are examples of what Russia has managed to do to overcome the impact of the sanctions. For Canada, we find that the estimates are also consistent with Setzer and Frank in 2017, as well as with arguments about Alberta by Burlton and Abdurrahmans in 2018. In terms of the impact of pipeline politics, we find that Canada is negatively impacted by pipeline politics when oil prices are in the low oil price regime, particularly below 47 to 50 US dollar per barrel. When the oil prices are below that threshold, so it's in the low oil price regime, an increase in oil prices has a negative effect on the Canadian current account, supporting the Dutch disease argument that an increase in oil prices hurts non-oil sectors. However, when oil prices are higher than 74 to 76, so in the high oil price regime, an oil price increase benefits all the other sectors, so means that it overcomes the challenges associated with the Dutch disease. We also find...
Sorry now to interrupt. Sorry, yes, sure. Sorry now to interrupt. 3 minutes left.
Yeah, I'm finishing. Thank you. We also find that there is the impact of there is a positive impact of the capacity utilization associated with a negative impact of oil price differential under the low oil price regime, indicating that that this positive impact of capacity utilization needs to be associated with an increase in takeaway capacity. So the increase in production is not offset by a decrease in oil prices. So to conclude, a reasonable oil price is greater than 61 to 65 US dollar per barrel for Saudi, 57 to 58 for Russia, and 74 to 76 for Canada. When accounting for sustainability, that increases to 72 for Russia and 67 for Saudi. We know that Saudi has the lowest cost of production for oil, but despite that, it has higher external break-even than Russia, which suggests that it's more vulnerable to oil price shocks than Russia. I'll skip that for the sake of time. Although Canada's financial sector is more developed and its economy is more diversified, our results show that Canada has a higher threshold than both Russia and Canada. It's particularly high, 74 to 676 or even 85 US dollar per barrel, which reflects Canada's vulnerability to oil price shocks despite its relatively more diversified economy. And accordingly, strategies are needed to increase the resilience of Canada and macroeconomic energy security. And I'm done. Hello? I hope I took 20 minutes only.
No, it's okay. But Maxime, we don't listen to you. We don't hear you.
And
Perfect.
okay, perfect. So thank you very much, Noah, for this presentation. And excuse me, I forgot to present you. So you are assistant professor at Regina University in the Faculty of Economics. So now is the time for questions and answers. So please, I see that Isabella have got raised her hand, and please, what is your question? I think open your mic, and we are not many people, so let's do it very informally. Please, Isabella, what's your question?
Yes, so hi, my question was actually about the slides where you had the different variables. I don't know if you can pull that one up again, because I couldn't remember all the names of the variables. And
so like the one that I referred to as the generic equation?
Yes.
Okay, sure, 1 second. This one?
Yes, and here I was interested to know about the PO diff. Is the oil price differential to capture the impact of geopolitics and pipeline politics? How did you, can you tell me more about that variable?
Okay, so it would be for Russia, it's the spread between Brent and the Russian Urals. For Saudi, we attempted to use the Arab Light oil, but for data availability issues, we used the spread between Brent and the Fateh oil price. For Canada, because the royalties are actually calculated using the Canadian dollar equivalent of the WTI. So we looked at the spread between the WTI and the West Canadian Select oil price.
Thank you. It's a very interesting paper. Is it available?
Yeah, sure. And I'll be happy to share it with you.
Oh, great. Thank you. Thank you.
Thank you.
Okay, thank you, Isabella. Is there any other questions? Okay, maybe in this case, I will take this opportunity. And currently the oil price at $71.89. So given your model, what would be your advice for this country? And it's, I guess, kind of closing for a year at least. So, what does it mean for this country?
So the oil price, you mean, is around $71 US
Yes,
per barrel?
exactly. The Brent is at 72, let's say.
Well, this is a hard question. But I think what it seems that the thing is, with the increase in demand, given the vaccination thing, things are improving. So yeah, the oil prices are pulling up because there is an increase in demand relative to the supply. But I guess the advice then here is then still not to over increase the supply relative to the demand, or otherwise oil prices will drop again. So maybe that would be over the envelope answer to that question. So because if oil prices reach 65 US dollar per barrel, this is not good news. I mean, based on that model to Saudi Arabia, it might be good news for, or still comfortable range for Russia, but not for Saudi. But again, and for high cost oil producers, it's still not a high oil price, not enough for them. So to keep up the good work, I guess they still need to keep an eye on the demand relative to the supply. So not to get overexcited about it, I guess.
Okay, so what I understand is that we are now in the reasonable range of oil price for this country, or even. Okay. Any other question? Yes, Igor. Well, I see that you are clapping, but
yeah, sorry, wrong button.
Wrong button. Okay, I thought that you
Sorry,
were
no.
You were raising your hand for a question.
I'm raising my hand. So I just had a question on Canada, I guess, and the result that you get from the Dutch disease. So what's the role here of a stabilization fund? So I'm wondering about whether there is some revenue smoothing mechanism happening there or not in place, so that actually the increase in oil prices is hurting the other exports. So can you tell something about that, or what is the mechanism?
I'm not so can you clarify the question? I'm sorry.
So usually, and I think Alberta has this stabilization fund, they have this savings fund. So when you have these shocks in oil prices, when you have high oil prices, you basically saving. So you don't spend it in the economy, and you don't get this effect on the exchange rate. So you don't deter these non-oil exports, let's say. But I'm wondering if there is when you're thinking about Canada, if there's something, is the central bank acting in that way, or are the results just saying, look, we are not acting on these shocks by any measures?
As much as I can understand the question, because I can hear everything you said, I'm sorry about that. So correct me if I don't, if I get off track and I'm not answering your question. So basically, in Alberta, they have had this stabilization fund. It has not been performing as expected or as it should. And then there is an issue for Alberta, as all other oil exporting economies, that they are, there is the pro-cyclicality of oil price. So when oil prices increase, expenditure increase, oil prices drop, everything drops. So this is a common issue for all oil exporting economies. In terms of the central bank, I'm not sure about this part in terms of Canada, because I know that the stabilization fund was an Alberta thing. So, and it is this stabilization fund is beyond the scope of this paper, but it's a very interesting point that, of course, I can use to build on this paper for future research.
Thank you. Thank you.
Thank you. Any more questions or comments? Maybe so I take the privilege of the chairman, and I will ask another question, but this time on the sustainable variable. It's a kind of, it seems to be a could you tell us a bit more how this variable enter in your model and how it impact the result of your model?
So this variable actually is actually calculated and provided by the World Bank. So they adjust the net savings. So they account for the expenditure on education and they account for environmental damages. When it starts in 1990 and it's only available on an annual basis. So this is why I kind of used it as a robustness check. For Saudi, that also kind of restricted my model, so I kind of had to remove the oil price. Remember when I was explaining the model, I said that the threshold variable is advised to be used as an explanatory variable, but I had to remove it as an explanatory variable and keep it only as a threshold variable because of this time sample restriction. But for Russia and Canada, because it's annual data, so I assumed that this value is constant during the whole year. So so I can generate quarterly series. So it's assumed to be kind of constant over a year. And again, this is why it's more of a robustness check. And then when that is included, the model results are robust. It only shows higher threshold values. So it is 67 for Russia, 72 for Saudi, and 85 for Canada. And even for the, in addition to those external break-even points, we were able to estimate oil price threshold levels that are kind of related to the oil sector. So we could find that, again, it's showing higher threshold values when we account for sustainability. So it's around $50 per barrel for Russia, around 63 for Canada, and around 38 for Saudi.
Okay, thank you very much. Is there any other question? Because we are reaching the end of the 10 minutes kind of time. But if there is a short last one, it's still possible. No? Okay, so thank you very much, Noha.
I can see Isabella raising her hand and she wrote something.
Okay. So you've got the last one and it should be a short one.
Yes, it is a short one. Actually, it's a question more to Maxime maybe or anybody else in the audience, not necessarily just for Noha. There's a lot of talk about big oil companies due to the move to sustainability right now, which you just mentioned with your variable, that there would be a lot more investment in sustainability and insufficient investment actually in the oil sector itself and might lead in the short run to maybe higher prices. Maxime, maybe you or, well, is there any comment on that? That's a short question.
Well, I would be happy to answer this question, but maybe Noha, do you have any views on that? Or
no, not at the moment. So I can
okay.
to the floor.
Okay, but well, so it's not on this issue. It's a very interesting issue about this sustainability, and especially it was very interesting to see that a sustainable variable is included in this kind of modeling. Typically, as you say, it's if you are at the International Energy Agency, well, the answer is kind of obvious given their last report on this net zero emission part. In a sense that yes, there will be kind of a lack of investment in the next this year and for the following years. Well, if you are not in this kind of extreme scenario, you'll have also a kind of a very strong issue around that, because and it's more linked to the COVID, the short-term effect of COVID, in a sense that currently all the oil and gas company has stopped investment, meaning that the time to restart their investment, even just to kind of maintain production, means that we may have another shock in the coming couple of years, as soon as the stock are well, a bit more empty than they are currently, because they are still very high, very, very high. So we will need these 2 years. But that's my opinion, and I do not have the time to provide you my model to tell anything about that. Let's stop that here and give the floor to. So thank you again, Noha, for this nice presentation. And let's jump to the next presentation. And I think it's Igor that is presenting. Igor is from the Rice University in Houston, and he will present us a paper along the different dimensions to be taken into account for field auctions. So please, Igor, the floor is yours. And as usual, you will have 20 minutes to present from now.
Until now. Thank you very much. Happy to be here. Good morning, good afternoon, depending on where you are. It's a pleasure to be here sharing my research on how fiscal and contractual frameworks may affect auction performance and government revenue. So I'm just gonna go ahead and get started and just explain the part of the motivation and the question that I'm trying to answer with this paper. I'm still working on the estimation of the entire model, but I think I want to provide today some intuition on what's happening, right? So oil companies, as we know, they face several risks. You have the uncertainty in oil prices and the swings in oil markets, as we already saw. And they also face geological uncertainty regarding the size of the resource base. And there's also some above the ground issues. So legislation or institutional framework may affect also the operations of a company. We also know that economic conditions, as they change, they may also affect the fiscal framework. So they have to adapt to this changing environment. So if we have large swings in oil prices, or if we have a massive discovery of oil, for instance, and the fiscal framework is not flexible enough, then we probably have to change some of the issues or the rates in some of the cases. Because if we do that, or as a government, if we do that, then these extraction and investment decisions can change if these conditions change over time. Particularly, I'm interested in looking at countries that use auctions to allocate leases because I want to see what's the effect on bidder strategies. So how these changes may affect this perception from these companies. And so in general, my question for today will be essentially how these changes in fiscal regimes may affect company behavior, and I mean bidder strategies, extraction, and investment. I'm going to focus particularly on the case of Brazil. They opened the oil sector to private investment in 1997 and started to conduct auctions in 1999. Initially, this system relied mainly on, or the fiscal system relied mainly on royalties and taxes under concession contracts, where the company had pretty much the property on the oil. And to allocate these leases or these fields, you were using not a single dimensional, like a price auction, but you were using a multi-dimensional auction. And I will explain in a minute what's that about. So Brazil finds oil, Petrobras finds oil in 2007, a massive quantity in offshore, in pre-salt. And after that, the government starts seeing the opportunity to change the legislation so they can get a higher share of government revenues. And in that sense, they introduced a change in the law in 2010 that introduced a production sharing contract or regime for these particular areas in the result, and also the way that they were auctioning these fields, at least for those fields. So in that sense, it was a single auction, where basically companies that were deciding how much of the profits they were willing to split with the government. And so because of this, because this is the parameter they're using, I think it is important to relate what happens in the auction stage to what happens later on the exploration and development of an oil field, and basically if they develop a field or not, for instance. With this model that I'm proposing, I use data from auctions, from the fiscal structure, and from the estimation from resources to get the operational cost and the investment cost from these companies. And then from this distribution of costs, I will sample and then simulate different bidder strategies, different extraction levels, and different government revenues under concession contracts and under the production sharing contracts. So just to compare in terms of government revenues, if actually the production sharing contracts were bringing higher revenues for the government, which is the claim from the government. As I was saying, in the concession contract, the company assumes the exploration risk. They get reimbursed to tax credits, but they use some sort of combination between royalties and some taxes. In the case of production sharing contract, the company only gets reimbursed if they find sufficient oil in commercial quantities, and after that reimbursement or partial reimbursement, they split the profits with the government. And so, how do they split it? Based on the percentage that is decided on the auction. Why am I focusing? Why is my interest on integrating the auction to this part? Because globally, it has been estimated that profit taxes or profit shares are pretty much between 70 and 80% of government revenues. So if competition affects the profit share, that affects 70 to 80% of government revenue. So that's why I'm interested in using this type of models to evaluate what the effect of competition into government revenues. So this pretty much contributes into 4 different lines that I can think of. It expands the study of scoring options, of multidimensional options. So because it allows you to say, well, based on the government preferences, I can choose different dimensions, and that affects the extraction and investments for a country. Basically, I'm adding a model of exploration and development to these fields. And as a second part, I'm also expanding on this idea of contingent payment auctions. So basically, the idea is that these are auctions in which you only get to pay the profit share, for instance, if you develop the field. So this is kind of different than price auctions where you're just bidding the cash bonus, for instance. And so I'm interested in adding this level of decision in which you decide how much to extract. In some cases, you assume that the quantity of oil is fixed. So I'm trying to add some decision level into that part. I'm also using a model from Professor James Smith. In this case, he has a model of tax avoidance and optimal development and exploration for a field. In this case, I'm adapting that model to include an auction stage in order to see how these profit shares and the dimensions may affect the value of this block, and to understand the effects of changes in the fiscal structure. And of course, there has been an extensive discussion of PSC and concessions in the Brazilian case. I'm just mentioning a few papers here. What I'm adding here is just adding an extra layer of auction models into this analysis to get another idea of what's happening here. As I was saying, you're using multidimensional auction. So in this setting, companies, they submit a signature bonus, an investment commitment in the exploration stage. They send a local content commitment, and based on that, it's calculated through this formula, which is known to companies, and whoever gets the highest score is the one that wins the auction. This is the one that has been implemented since 1999 with different weights, but that was the formula. In the exploration stage, then companies, they have to pretty much spend that money, that exploration commitment, they have to pay the signature bonus and buy some portion of the goods to local companies. As I will say from an economic point of view, and I will explain this in a minute, I will say that from a cash flow perspective, I think the main difference between the two contracts is that in some case, in the PSC contract, you're basically having a profit oil that pretty much is decided in the auction stage, which is in the case of the concession, you have a profit tax, or what they call a special participation tax, which is based on production levels, which is set by law. But as a whole, there are different mixtures of royalties and income taxes and some more ways that you can get reimbursed. But in any case, at the exploration stage, what I'm saying is the company will choose if they move to the development stage and how much oil they will extract into that stage. Why am I thinking that the decision of how much oil to extract is important? In previous cases, it has been shown that different contracts, in the case of Brazil, could induce different exploitation strategies. And that means the position of the injecting wells and the position of the producing wells, for instance. And I'm also interested in the incentive component for these companies, because it has been shown also that it is very important to see what are the mechanisms in terms of cost reimbursement and tax credits. So if you get a higher reimbursement, then you may have more incentives to do that, to invest. But in general, the two types of contracts, they have the same issue or the same idea that the company is the residual claimant. So after all taxes are collected, then the company gets something out of the value of the project. So from an incentive perspective, they're similar. So it kind of puts the question on why would you change the concession contracts as a whole. In terms of data, I'm just using data from result. Notice in red that there are significant differences in the bonuses. In the case of these rounds on the left, this is set at the auction stage. In the case of the PSC contracts, this is fixed by the government, this is set by the government, the same as the exploration effort. And but notice that the difference in here in the values is mostly due to the size of the resource. So as we can see, for instance, the finding of 2007 was between 4,000 and 8,000 million barrels. So that means 8 billion barrels. So that means that there is some significant differences in productivity here that they are not due to the contract, but rather to the geology. And this is something that I wanted to examine also empirically. Notice in this map, which is on the pre-salt, that I'm basically including all the blocks and just mapping the bonus per square kilometer to try to understand if there are significant differences across contracts. So within the circle, you have the PSC contracts, the production sharing contracts. And outside of it, these 15 and 16 are just concession contracts. So coming from these routes. So notice that after the discovery of oil, the bonus per kilometer square it's somewhat higher in the case of concessions than in the case of PSC. So what we're seeing here is that already after the change, there seems to be something different in terms of the government revenue. So it kind of goes in the opposite direction if you only look at the bonus in this case, which is something that I explode, I examine later on. Also, we need to take into account that there's still uncertainty and only a fraction of the projects gets developed. So that's important when we're moving forward. I only get to watch production and research for those fields that were developed. So I have to develop some methodology for estimating the resources. But in general, what I wanted to examine before going to the model is just to explain whether in fact the production sharing contracts, there's significant differences between the two types of contracts based on just looking at the signature bonds or the cash bonds. I'm controlling for block characteristics, which is including the minimum bonus and oil prices, for instance. And what I notice here in this table is that the PSC variable, this production sharing contract variable, has a significant effect on the signature bonus. After controlling for all these scoring rules and all these different weights from these different options. But from here, I don't get to see, for instance, what's the effect on government revenues as a whole. I only get to see what happens with 10 to 15% of government revenues. So that's what motivates me to build a model in order to see what's happening on the other fraction of revenues. I only get to see from the data that the forecast for this taxation is significantly higher for the production sharing contracts just because these are located in areas that are more productive. So, but I don't get to control for the size of the resource, which is something that I need to see later on. My model in general, before I go to the simulation, is just has 3 stages. So they have an option stage. They have to decide this multidimensional bit or the profit share part. Then they have to decide whether they move to the development stage or not. And so they learn something about the quantity of oil on the ground. This is a simplification from the Smith model. So in this case, I'm just saying that they're learning about a shock in terms of the oil quantity, and based on that, they will move to a development stage. This profit function, you just model after James Smith also. So in that way, depending on the extraction level, I will get different profits, controlling for resources and tax structure. In my model, I need to estimate to identify the operating cost and the investment cost. And I'm also assuming that companies know the distribution of this cost for the competitors and also know the distribution of these shocks before making their bids. In red, I'm just pointing what are the bid dimensions. I'm only going to assume that they're bidding on bonus and the investment part because the local component part is not relevant. There's no variation in that part. So in that sense, I'm only focusing on that part. As a whole, what I'm saying is that the value of the oil field, it's coming from the profits from the development stage. I'm paying my exploration commitments, and depending on the size of the shock, if the shock is productive enough, if I see enough oil, then I will move to the development stage. So this is all that is saying, this fuzzy math, this is all that is saying. If the shock epsilon is sufficiently large, I will move to the development stage. And for the bidder, they just basically have to choose the bonus and the investment commitment so that they maximize the profits, the expected profits. So the probability of winning the auction times the value of that block. And so the idea is that depending on the shock that they observe, if the shock is higher, they will be higher as a whole. I don't get to do the whole estimation. I'm just going to show a little bit of the results of a simulation that I did, just to show you some intuition on why competition matters. But just to say that from the data that I have, the auction data, controlling for the resource and for expected oil prices, the variation in the investment commitment allows me to identify the investment cost, and the variation in bonus allows me to identify the operational cost. And so what I'm doing for this exercise to try to compare apples with apples, let's say, I will have some assumptions on the size of the resource, and I will estimate the shocks from the distribution of fields that I have in the pre-salt using data from RISE. I will compare the exports profits from these both concession and production sharing contracts, but I also need to make some assumptions about the bidding strategy in the production sharing part. Why? Because I don't know the competition yet. I don't know the probability of winning yet for that. So I need to make some assumptions on that. And depending on whether there are 2 firms or 3 firms competing, I have different probabilities of winning. And that would affect my bidding strategy. If the intuition would be, if I see more competition, I will bid higher in order to win the field. And so what I will show now is just saying, yeah.
Sorry, yes, 3 minutes left.
Okay, yeah, I have just 2 slides. Perfect. So what I will say here is that by showing these results, I'm just comparing concession contracts, the distribution. This is just a box plot on the concession contracts. This is actually $1 billion. And what I notice is that these results are somehow sensitive to this assumption on the competition part. So if I'm assuming 2 competitors bidding for the production sharing contracts, the government revenues on the concession contracts are slightly higher, but not significantly. But in the case of if the competition increases, then the difference in revenues will be somewhat in terms of net present value of something about 5 billion. So production sharing contracts will be higher. So notice that depending on the competition, government revenues can be higher for one contract or the other. So that's why it's important to estimate this distribution of winning probability. The other experiment I just did, before going to the conclusions, is just assuming different levels of cost recovery, because that also affects incentives for the company to extract more or less oil. So in this case, as I'm reducing the cost recovery, then I'm getting, I'm making less transfers to the company. So the government revenues somehow are higher. But at the same time, I'm disincentivizing the company to extract more, because then from a cash flow perspective, they don't have enough incentive to be productive. So depending on these assumptions as well, you will have different scenarios for revenues, and in some cases the production sharing will be higher, in some others the concession contracts will be high. Just to finish, just to wrap it up before comments, I need to estimate this distribution of private costs, and probably allows for some uncertainty in prices as well, because I'm only allowing for uncertainty in geology in this case. But definitely results show in the simulation that you can get different ordering between government revenues, between PSC and concession contracts, but that's why you need to account for the full cycle of revenues, including from the auction stage. The other thing I didn't touch here is that including profit shares may induce problems of adverse selection, just because the intuition will be, and this has been documented, that probably high cost companies may be more aggressive in terms of their bidding, because they treat this field as an option. Only if prices are high enough, they will develop the field. So they don't care, they don't mind that much to bid high, and if they don't win the field, that's fine. So you can understand that there's other important dimensions here that may affect the execution of the project. So just a bit of everything from what I see. Sorry if I rush into the explanation, but if you have any questions, happy to hear you, and thank you very much.
Okay, thank you very much, Igor, for your presentation. So now it's time for question. Does anybody have got some question to better understand, or to continue the discussion that Igor just opened? Yes, James, please.
Oh, thank you. And thank you, Igor, for the presentation. Very interesting to see this update on your work. That's come a long way. You point out correctly that the trade-off between government revenue received via bonus bid in the auction versus the profit sharing component of revenue, and indicated correctly that the bonuses are much smaller with the profit share, very rationally, because the profit share is going to be making up for that. On the other hand, in the concession system, there's much larger bonuses, no profit share, but the bonus is received on every block that is auctioned. Whereas the profit share revenues are only received on that portion of blocks that actually reach development and production, which I think you indicated was relatively small. And so I'm asking if you've done any calculations that take that difference into account. That is it possible that the large bonuses on concessions received every time more than offset the fact that bonuses are smaller on the production sharing contracts?
Yes. So yeah, thank you for the question. This is something, again, I'm trying to run several experiments, because I just wanted to show a simulation, because I haven't done the estimation of the cost yet. So somewhat comparing different distributions. But I would say this: what I'm actually doing in the model here is that the uncertainty in the geology somehow affects the execution of the project. So even though you correctly point that if you have you may have a higher bonus in the concession contracts and you have to pay it regardless of whether the project gets developed or not. What I noticed in the case of the production sharing contracts is that they set this bonus at a really high level because they know the geology is pretty good. But the problem here is that you don't get that much competition. And because you don't get that much competition, then that affects in turn the profit share that you're getting. So what you may be gaining on the bonus part, you are somehow losing it by the competition, by the lower competition. If firms are aware of this trade-off somehow, if they know that they're not going to face competition for it. So I think I know from industry participants that this has become an issue. The fact that you're having these high bonuses. And I'm also not considering here in the model the role of infrastructure. So in some cases, some companies, they actually not only want to operate the field. So if they have to make a joint bid with Petrobras, the national oil company, they might not be that interested in bidding as a whole, but because they want to bid as an operator, but they need to get access to infrastructure for the recollection of this production, because it seems to be that the case, which I need to think about it more and get more data on it, that Petrobras controls the pipeline, and so they might extract some rent by charging this transport. So I think if you look at the data organized by space, I see that you only get a few participants coming from companies that were already operating in that area. And so that limits the competition as well. And so that's another effect beyond the reserve prices that I think it's also entering into the calculation. But yeah, definitely, this could be something that I could quantify, because then I will need to model the entry decision.
Okay, thanks for that.
Sure.
Okay, thank you. Any other questions or comments? Okay, so maybe I will have one. I understand, in fact, through your presentation, that in fact concession type of contract are better used for smaller fields, and production sharing contract (PSC) would be more for larger field. Would you confirm that through your study?
That was I guess that was the argument of the government, and this brought a lot of discussion because once they discovered the fields in 2007, they basically stopped auctions from 2008 to 2013 while they were changing the legislation. And I think the problem was that companies were arguing that you didn't need to introduce a production sharing contract, because you could get the same amount of, or tweaking some of the taxes, particularly the special petroleum tax, because it acted somehow as what they were intending with the production sharing, the split of it, let's say. And so some people were arguing, essentially, you don't necessarily need to introduce a new contract for pre-salt. You could use concession contracts. This is what I'm trying to test here with this paper, whether in fact there was disadvantage. But to the question on which one is better for which, I think it depends on what I was saying, depends on the cost recovery that you had in both contracts. And so that would depend on the reimbursement that you have, and that would also depend on the competition that you're facing, because again, the bidding variables are not the same. I would also say that this is from an economics point of view. There are also legal differences regarding the property of the resource, depending on the extraction point or the commercialization point, that I think for accounting purposes for the companies that they may have some value implications, especially if they have stock, like if they're IOCs, for instance. So I think there might be some other legal aspects of it that I'm not covering here. So I'm just focusing on the cash flow and incentives part. So that would be a bigger question, I would say, if you include that legal aspect. But yeah, this is something that, to be honest, as of now, it's still something to be. It's a question that is open.
Thank you very much. Is there any other comments or question? We will still have 1 or 2 minutes for Igor. Okay. Well, so in this case, thank you very much, Igor, for this nice, I would say, dig in the auction mechanisms in Brazil. And now let's move on the last presentation for this session. And Sindre, so he's from Stavanger University, and he will discuss with us how what will be the factor influencing exploration success rate, and by keeping, in fact, the commercial view in mind. I would say it's probably a very bad summary of the extent of the paper that you will present, but still now the floor is yours, and please so present it to us.
Thank you for the introduction. Can everyone hear and see me?
Yes, thank you.
Let's see if I can manage to turn on the screen sharing. Technology is not quite my friend, I'm afraid. Do you see my presentation here?
Yes, it seems to work.
Perfect. Okay, so the title and my name is on the screen, but this paper is written together with my co-author, Professor Petter Osmundsen, and we are both from University of Stavanger in Norway, and we both belong to the domain of industrial economics. So the motivation and background for this paper is pretty straightforward. If we want to produce oil and gas and petroleum, we need to first discover it because it's concealed underground. The problem with exploration drilling is that it can be quite expensive. So a company would like to maximize the probability of success when they are making a wildcat well. So that leads us to the research question of this paper. What are the key drivers of exploration drilling success on the Norwegian continental shelf? So just a little bit of background here. This type of topic is typically researched by geologists, and they will have models full of variables which are geological. Me and Professor Osmundsen, however, we are not geologists, we are economists. So we are basically trying to address this research question from a little bit different perspective, from the perspective of our domain. So we are not really interested in putting in these typical variables that the geologists would put into their modules. So we are mostly going to ignore that and basically only apply the type of variables that an economist would be interested in. Just to introduce a little bit of terminology, success comes in many different shapes and forms. We operate with two kind of categories of success. We have something called technical success or technical discovery. That is basically a wildcat well that we find hydrocarbons in. Does not matter how much or how little or the quality. If there's oil and gas in there, then it is a technical success. A commercial success, however, and I see there's a mistake here in this LaTeX figure. Igor, you were also using LaTeX, so I guess you can understand the troubles of making LaTeX presentations. But a commercial success is basically a subset of a technical discovery. It needs to be sufficiently large in order to be commercialized. And that can be a bit problematic because our technical success could change into commercial success later on as technology becomes better, it becomes cheaper to extract oil and gas, and also as the business cycle is changing. So we are only going to look at the technical success. So we're going to run a regression basically, and the left-hand side variable is going to be technical success. And that's just a dichotomous binary dummy variable. Is equal to 1 if the wildcat well encounters hydrocarbon, and 0 otherwise. And the model we're going to use is a logit model. So you academics out there, you are probably very familiar with logit models. People in the industry, maybe not, based on what I've seen from the various companies here in Stavanger. They tend to use linear models, the standard ordinary least squares regression approach. And the issue with that is that you can violate the fundamental axioms of probability theory as laid out by Kolmogorov. So basically what can happen when you apply a standard OLS model is that you can get probabilities which are negative probabilities, and you can get probabilities which exceed 100%. So basically you can end up with this scenario, which is why we are applying logit regression model to kind of circumvent or remedy this particular problem. So the model we're going to run is pretty standard here. Probability of having success on the left-hand side, and variables, explanatory variables on the right-hand side. And this is estimated using maximum likelihood estimation, which can be a little bit technically complicated, but luckily the software is here to take care of that. So we have been in dialogue with the Norwegian Petroleum Directorate, which has been providing us with the data set, and they are kind of the experts. So we had a dialogue with them to kind of figure out what type of variables do they expect. And they are the subject matter experts. But we have been applying a little bit more of a data-driven approach to kind of figure out which variable is best at explaining or predicting success. So we're using a forward selection procedure here, essentially. And the technicality behind that, I don't remember anymore because it's been 1.5 years since I actually wrote this paper. But if you want, you can ask me about it later. So as I said, the data comes from Norwegian Petroleum Directorate, and we have basically every single wildcat well that has been drilled in Norway from its very inception in 1966 until when this paper originally was submitted to this conference in 2019. And there's a lot of descriptive statistics that are generated, but I realized it's far too hot this summer, so I don't really want to go through them. But here we have how many wells were drilled for each year in Norway. And we also had a number of successes. So if you look at the success rate, it's kind of oscillating here, but it's in an upward trend. So that is kind of interesting. We'll come back to that later. The rest of the descriptives, I'm just going to skip. So after we did the econometrics, we identify 4 different variables that were statistically significant and that provided the highest R squared. And just a note there, it's a logit model, so we don't operate with R square, we operate with pseudo R square, but basically the same. So the 4 variables, and this is sorted in order of importance. We found drilling speed to be important, and we measure that as the number of meters drilled per day. The second most important variable was the year when the drilling was initiated. And the third was the drilling depth. And the final one is just the oil price. So pretty much anything in petroleum economics, you're going to put in the oil price there as an explanatory variable, unless it's on the left-hand side. So here we have the regression results. And just a note here, these are not actually beta coefficients. This is e to the power of the beta coefficient. So this is so-called odds ratio. And I'm going to explain what the interpretation is. So the most important variable we found was drilling speed, and that has an odds ratio of 0.9909. So what this means is that if drilling speed is increased by 1 meter or 1 unit, then the odds of success is going to increase by 0.91%. And again, this is a logit model, so it's not a 0.91% increase in probability, it's an increase in the odds. 2 different things. This is interesting because it's negative, basically. If the odds ratio is less than 1, then the effect is negative. If it's greater than 1, then the effect is positive. If it's equal to 1, then there's no effect. So by drilling faster, you decrease the probability of success. So what's going on here is basically we have a violation of the population orthogonality condition. So it's not causality going on here. We suspect that it's reverse causality. Because if you do find evidence of hydrocarbons in the wildcat well, then you need to stop and do some additional testing. So this is basically a result of reverse causality. The second most important variable we found was entry year. The further into the future you are, the higher the chances of success. And we basically believe that this is basically technology. Technology becomes better and we gain more and more knowledge and information about the Norwegian continental shelf. So over time, it makes sense that we become better and better at exploring and finding the petroleum. However, you can also make the argument that there's a low-hanging fruit hypothesis here. You're going to pick the most easily available hydrocarbons first, so maybe over time it will be more difficult as there's less and less available. But so far, if I go a few slides back here to the descriptive statistics, we see that it is increasing over time. However, this is basically an in-sample result. I don't want to make the claim that this is going to hold true in the future. So it could be the case that out of sample, this is going to change. Currently, it's an upward trend, but this might change. It could become flat, or it could even start to decrease as we move on. Now, the third variable we found there is the drilling depth. And this one is positive. By the way, I didn't mention the, so 3.61% increase in the odds. That's the effect of the previous one. So here, when we drill 1 additional meter, we increase the odds with 0.3. And this variable has given me a lot of issue because this is kind of counterintuitive. So here I made a very nice diagram in LaTeX. So this is programmed. Igor, you probably know how difficult this can be. And the issue is, like, if you drill an additional meter, you're going to increase the probability of finding oil and gas if there is oil and gas down there. So it's a very interesting anecdote from the very beginning of Norwegian petroleum history. Amoco, Norway oil company, they were drilling 2,595 meters, and they gave up. They didn't find anything. But it turns out if they had gone an additional 43 meters, they would have found oil and gas. So based on this logic, if you drill further, you would indeed increase the chances of finding oil and gas. But I suspect there's a reverse Tinkerbell effect here. If everyone started to just drill to the maximum, this effect will essentially disappear. And the reason is that if everyone were to drill to the maximum depth, you would only stop at the maximum depth or when you encounter oil and gas. So in other words, we will end up with the exact opposite effect. So that is kind of counterintuitive and also kind of interesting if you ask me. This effect exists now, but once I pointed out, and if everyone to act upon that, this effect or relationship will change. And the final variable is the oil and price, and it's lagged because we think there's some inertia here. And again, it is has a negative effect. So a $1 increase in the crude oil price will decrease the probability of success by not the probability, but the odds of 0.5%. And this is essentially just a result of omitted variable bias. There's nothing magical about the oil price, but the oil price has an effect on the behavior of the oil and gas companies. So we suspect that the oil price is functioning here as a proxy for the business cycle and how much available cash flows the oil and gas companies have. So we hypothesize that the behavior, the exploration behavior of the companies will change throughout the business cycle. When you have a low business cycle during the bust, then the companies become more risk averse. Perhaps they will select projects which they believe has a higher probability of success. They want a certain thing in times of uncertainty. When you have a high business cycle, on the other hand, perhaps they become more willing to take on risk. Perhaps they're doing more novel projects and want to try out new things. So maybe the probability of success decreases, but they're trying to aim for the larger deposits. And that is basically it. So I may try to make it short and sweet. And if you have questions, then feel free to ask them.
Thank you very much, Sindre, for your presentation. And so now the floor is open to questions. So please, if anyone have got questions or comments.
Yeah, Maxime, can I ask a question?
Yes, Arturo. Yes, please.
Yeah, hello. Hi, Sindre. Thank you for your presentation. Very interesting to see results. I was wondering, well, yes, of course, a good explanation of the intuition about the oil price. But I was wondering if maybe in the discussion with when you were making your paper, did you discuss controlling for oil field size or the size of discovery? Because I would say that maybe, for example, the older fields will be of a higher size than maybe more recent vintages one, and maybe if you control for those types of discoveries, you will find some different signs, or maybe it will be important to highlight the success of discovery by oil field size or discovery. So I don't know if you discussed that in that time, or what are your thoughts about this?
Yeah, I agree. We had quite a few variables we were selecting from. And what we notice is that when you run them univariately and then you put them in a multivariate model, quite often the relationships tends to change. So oil price had the opposite effect when it was univariately. So it's quite reasonable to believe that it could be the case that when we include another variable that this will change. So that would be an indication of omitted variable bias. And discovery size, I seem to remember that was one of the variables we had in there. Okay. I'm pretty sure of that, but it was not selected. So we did a forward selection procedure. So we only selecting variables that is, has a significant effect, p-value less than 0.05. And also we select the variables in order of trying to maximize the pseudo R-square. Okay. But discovery size is an interesting
that was
variable.
Like so it was more based like on let's say on a way to optimize the model for a certain loss function.
Yeah.
And from there you okay. So that's why maybe it makes theoretical sense, but maybe it didn't add let's say any breakability to or a better R-square to the model. Okay, I see.
Yeah, so we're trying to do prediction here. The causality here is obviously non-existence because we have violations of the fundamental assumptions here in every single variable. We have reverse causality, we have omitted variable bias.
But it makes sense if you were trying just to have this predictability, right? Yeah. Okay, makes sense.
Yeah, pseudo R squared is what we were trying to maximize in this particular instance. So that can be considered as a loss function.
Okay, perfect. Thank you.
Thank you. Any other question or comments? Yes, please, James.
Yes, thank you. And thank you, Sindre, also for an interesting presentation. I had one question for clarification on the slide that you actually have on the screen now, and then one comment also. Mm-hmm. So as I understand it, the way the odds ratio affects the interpretation is that the variable really has no effect unless that coefficient deviates from 1.0.
Yeah, that's right.
Now, the p-value, on the other hand, what is the null hypothesis underlying the p-value? Is it that the odds ratio is equal to 1 or 0?
The p-value is calculated based on the beta coefficient. So beta equal to 0 is the hypothesis test there, but the odds ratio is just e to the power of beta. So if beta is 0, then the odds ratio becomes equal to 1. So asking if the odds ratio is equal to 1 or if beta is equal to 0 is two equivalent questions.
But with the nonlinear transformation, I guess that's it's just not clear to me how to interpret the significance level when we've translated the original variable, the beta, to an odds ratio.
Yeah, so the odds ratio has a linear effect on the odds, but a non-linear effect on the probability. So the probability will be this S-shaped curve right here. But if we transform this into odds, it suddenly becomes linear. So this logic models can be a bit difficult to both interpret and explain, and I made a few mistakes myself in this presentation. So easy to confuse probability with odds here. So this here represents the percentage effect on the odds, and odds is just probability divided by the probability of not happening.
So then it's fair to interpret, for example, the drilling speed, which the impact on the odds ratio, as you said, was only 1/10 of 1%. Was that correct?
Drilling speed, you said?
Yeah.
Drilling speed, yeah. So
okay, yeah, just less than 1%.
0.91% increase, not in probability, but increase in the odds.
In the odds, and that increase in the odds is significant at the 99% level.
I think I was operating here with 10% in my inclusion criteria, but see, this is significant at 1% level,
Yeah.
It's truncated at 2 decimals here.
Okay.
So they're quite significant. Oil price is the least significant here because when you add more and more variables, the last one becomes less and less significant due to correlation with the other variables.
Yeah, well, okay, that helps a lot. Thanks for that. And my comment was that when I think about exploration success, I imagine that a company has a portfolio of prospects at any time, and that it makes a selection based upon some decision model. And for example, a prospect that is more certain in terms of geological indicators has a higher probability of success, but it also has a higher probability of being selected for drilling in the first place. Prospects that are very deep are going to be expensive, and therefore they would only be selected if they had, in other terms, a higher probability of success. I guess what I'm saying here is that the results don't seem counterintuitive to me. I thought you indicated that that coefficient was counterintuitive, but I would expect companies only to drill the deep prospects if they expected to have a higher than average probability of success. So your comment on that.
What was the question again?
Do you think that the coefficient for total depth is counterintuitive, and if so, why?
Drilling depth. So it has a positive effect there, and this one is really difficult to interpret here. But I brought up a different issues than you are pointing out there. So obviously, they were going to select prospects that they believe there's high chance of finding oil and gas. But despite that, sometimes
no, that's the point that I'm making. That they will select prospects that they think have a high probability of making money, and a deep prospect has a lower probability of making money unless it also has a higher probability of success.
Yeah, obviously they're going to try to always maximize the probability of success there. But empirically speaking, looking at the sample here, we do find a positive effect on drilling depth.
Which is not surprising. That's my point. I thought you said that was counterintuitive, and to me it's not.
No, that part is in alignment with the problem is that if everyone were to act on this model, then the application there would be okay, you should just always drill as much as possible. If everyone were to do that, then this relationship would change from being positive to being negative. Because either you drill to the maximum depth or you stop when you find oil and gas. So this is actually an issue with, in Norway, we like to have cabins, and usually you don't have access to the pipes with water, so we need to dig wells. So the companies, they usually drill 30 meters, and then they try another place. So when they look at their data sets, they will find there's a negative relationship because either you drill 30 meters or you find the groundwater. So when they look at their data sets, they find a negative relationship.
Okay, thank you very much.
Yeah. Okay, so any other comments or question on this paper? Okay, well, and effectively, as James, it's I kind of agree with James that maybe this total depth interpretation is a bit tricky there, because it seems that since it's because in fact the field, so the well was drilled because they already know that there was a better probability of success. So it means that the odds of success tend to increase because of each additional meter of drilling in this case. So it's kind of a bit tricky on how to use this variable as a predictive variable of the success, the final success. But anyway, it's a very interesting way to discuss these values, and based on the historical data on Norway. Maybe my question would be, do you think that the results that you've got with the discussions that we already have on these variables could be extended to other places in the world, and so that you can say, okay, we can use these results to look at what's going on in Nigeria, for example, in terms of offshore drilling?
Yeah, so is there external validity in this research? I would think so, at least for the first three variables. If you are drilling for water, then perhaps oil price is not that important. Yeah, the year here kind of just represents that over time we develop better and better technology. So we would expect to increase chances of success over time. The drilling speed thing, this one doesn't have internal validity, so I don't really think it would have external validity, because this is just reverse causality. Drilling speed for successful wells are lower because they need to spend time on double checking and doing additional testing. For the oil price, that's kind of very specific. So I used the Brent crude oil price there. So perhaps, I guess it's kind of co-integrated with all the oil prices. But yeah, I don't see any reason why there should be any big issues there with external validity.
Any other comments or question? I can see in the chat that there is a question. Maybe I will read it directly to you.
Sorry, I think I see a hand from Igor.
Yeah, but I think that was a question first from
okay.
the WTI.
Okay. So please ask the question, and after we'll use the question that is in the chat.
Oh, okay. Thank you for your presentation. I just had a question on, do you have data on 3D seismic or 2D seismic that you can put into the model to see if you can get like another adjustment to the model? Maybe some proxy for information, let's say.
I'm sorry, I'm gonna have to ask you to repeat the question. Audio quality is
seismic exploration studies, some variable for
yeah, we have data on 3D seismic and 2D and 4D for a few years. So we have data on seismic activity, but we did not include that specifically because this is a kind of well researched. So we kind of ignore the typical suspects.
Right. And have you tried also, like, why the logic? Have you tried a Probit specification? Like, do you get different results from what you get here? Or?
If it's a Probit model, was that the question?
Yeah, so it's a Probit. So because I
yeah, so we applied a logic model. We could have tried a Probit model. In my experience, it's kind of potato tomato. So. But I could try that out. I didn't do that specifically for this paper.
Yeah, just different distributional assumption. I was just wondering what motivated the logic decision. That's fine.
Yeah, we could try that. As I said, we haven't done it so far, but as a robustness check, that could be interesting to do.
Yeah.
Thank you for the comment.
Okay, thank you. Maybe ST, would you like to tell us your question or directly? So that way it would be easier.
Yeah,
yes,
yeah. So
please,
yeah,
please,
I
ST.
just have a quick question. So do you think if we apply a WTI, the result would be consistent with the Brent one? And then if the oil price, you said in your last slide, I think, that it because of the business cycle. So if it's because of the business cycle, would it be beneficial if we control the break at that year, like say 2008 or something? So yeah, that's my question. Would it be help to explain it more? Because like I think like I do agree with James that if I were the companies that might be the high oil price will trigger the higher success rate to drill more and more. So that's my question. Thank you.
So would it be useful to control for the business cycle in a more elaborate way than just using the oil and gas price? Am I interpreting you correct there?
Yeah, And then about the WTI.
Yeah, I don't see any reason why it wouldn't be beneficial to do more elaborate, capture the business cycle more elaborately. I agree with that. So we kind of suspected that the Brent crude oil price is just a proxy for business cycle and for the behavior of the oil and gas companies. So if we could capture that more directly, then I think that would be a lot better.
Because from this, like, we don't know, right, whether it's like the real reason is because of the low and high business cycle, or it's just still like, okay, I think it would be that's the root cause of this.
Yeah, I completely agree. As I said, this is probably just a result of omitted variable bias. In such instances, it would always be beneficial to include the omitted variable to get more reliable results, to get better internal validity here.
Are you planning to write the paper?
To be honest,
do you have
not
to plan
really.
to publish this?
Actually, it's such a long time since I wrote this paper. The conference unfortunately got postponed a year. So I had to admit that this paper kind of fell through the cracks, fell into the drawer. So no, I haven't really done anything with this in quite a while now.
Okay.
I have pursued other projects instead.
Yeah, so I'll probably just send you email later on if I have any other questions.
That would be nice.
Thank you.
Okay, thank you for this question and this discussion on the oil price and business cycle. Any other comments or questions? Well, it's kind of the last call, so please do not hesitate. It's we still have got some few minutes in the dedicated time. So if there is any other question for any of our speakers, Sindre, Igor, or Noha, it's the time to ask. Okay, so. Thank you very much for your attendance to this session, and let's really thank our speaker Noha, Igor, and Sindre for this really nice presentation on this oil industry and on how to make it better in the coming years. Thank you very much for your attendees, and I please join me to thank our speaker by using either the reaction button to clap a kind of virtually on your screen, or to just open your mic and say bravo and really nicely done, especially for this first virtual session of the International Association of Energy Economists. I hope that we'll have the opportunity to see each other in other session or plenary session. And please have a great end of the day for all of you, and a really nice conference as well for the remaining part of it. Thank you.
Thank you all. Thank you all very much.
Thank you very much.
Thank you.
Have a good one.
Thank you.
Thank you. Bye.